All right, in the meantime, it is the holy grail, isn't it, for investors and owner-occupiers alike that can obviously make property so lucrative, and we're talking about capital growth, but we are seeing a softening in some markets, and particularly in Sydney. So what are the signs for what to watch for to be able to achieve that capital growth? Investment expert Michael Yardney, the CEO of leading property advisor Metropole Property Strategist, joins us now to tell us more. Michael, just first, I guess, set the scene for us, because we're definitely seeing some softening in some of those markets, and obviously all the markets in the country operate at different phases of the cycle, but we're definitely seeing a softening phase in certainly Sydney and Melbourne, would you say?
Definitely. After actually 5 years of strong capital growth, the markets are taking a breather. They've gone from fifth gear probably to second gear. They're not going in reverse yet, and we're not going to have a crash like some people are predicting. But you're right, Brady, the markets have slowed down. And so I think the topic that you just mentioned a moment ago is very relevant. What actually causes capital growth, so we know what to look for when we buy an investment, or what we look for when we buy our next home.
I'm wondering, you used the term the P's, the 5 P's. Can you explain those to us?
Yes, James. I've actually come up with 5 P's for causing capital growth. The first one is people. In other words, we know that population, or actually household formation, how many households there are, is one of the drivers of capital growth. You need all of these together. The next one is purchasing power, and that has to do with your wages and with interest rates, because when properties are affordable, or you've got good income and you can afford them, that converts demand into buying. The next one's position. Look, we know about location, 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 so you've got to have the right location, because some locations will drive capital growth. Property, you've got to own the right sort of property in that location. And the last P is places, how many of them there are, the old supply and demand ratio. And putting all those together, you can start to predict what's going to happen to capital growth.
Just on, I guess, some of the myths too surrounding capital growth and how to achieve it. Just on population, because, you know, there seems to be the sense that, well, if you've got population growth predicted for an area, then that's going to equal capital growth. Is that true?
Not necessarily. There's no doubt, Brady, that population growth, people wanting to live in the area, is one of the drivers, but it also has to do with supply and demand. So some of the reports that come out showed the fastest growing areas, and that's often in the outer suburbs, but they're growing because there's new stock there, new houses, new estates being built, but because there's sufficient supply for the demand, and because in general in these areas people's wages aren't high, it doesn't necessarily lead to to capital growth. So population growth, amongst other things, leads to capital growth, but not on its own.
I'm wondering, Michael, about the myth of investing in capital cities that are experiencing strong capital growth. Explain that to us.
Well, clearly the capital cities outperform regional Australia. Well, in general they do. And trying to invest in the big capital cities that have done well, Melbourne and Sydney, has been a good indicator for capital growth in the last couple of years, because a rising tide lifts all ships. But interestingly, within Melbourne, within Sydney, within all the big capital cities, there are markets within markets, some of them geographic, different price points, different types of properties. So you couldn't just buy any property in those big capital cities and hope for capital growth to occur. And as we move forward to periods of lower capital growth, correct asset selection is going to be important, and we've seen it every other cycle. There's a flight to quality. So good homes, the sort that you often show on your show coming up for auction, we have lots of people competing for them by homeowners, or good investment grade properties, they're going to continue to outperform, but the other areas and other sorts of properties won't. So no, you can't just buy in any capital city, James.
And what about land, you know, just buying land because it's always going to appreciate in value? Do you think that's necessarily the case?
Well, people say it's the land that goes up, and the answer is that is true. The land component is the main bit that rises, but not all land's created equal. I'd rather own 1/10 of a block of land in Bondi or Coogee or Albert Park in Melbourne or Peppermint Grove in Perth under a block of apartments in my share than acres in Port Hedland or some of the regional towns or in mining towns. So it's not just any land. Not all land is created equal, and so therefore as we move forward, it's going to be important to own land in the right location, and as our cities get bigger, that's going to in general be close to transport, close to amenities, areas where it's easy to walk to public transport or to the shops or to schools. And there's always the argument, as long as I've been investing, about regional Australia or capital cities. And I like investing, and if you're looking at buying a home, looking at capital growth by looking forward, what the future potential of the property is going to be. And that has to do with wages growth, that has to do with wages because of jobs growth, and jobs growth bringing people in. And what that really means is that's going to be where the big jobs are going to, in general, be close to town, close to the CBD, in the service industries. We're no longer a manufacturing country. The mining boom's over. So look for where those sort of jobs are going to be, and land around those locations are the right place to invest.
What about the people that are sort of thinking that you're likely to get capital growth if you're buying the negatively geared properties?
Well, some people say that you've got to negatively gear. Now, there's no doubt that in Australia, residential real estate is a high growth, relatively low yield investment. In other words, your good high growth properties are not going to have a good rental return, which means in the early years you're often negatively geared. But it's not the reverse, James. In other words, just because you're negatively geared doesn't mean you're going to get high capital growth. And have a look at a lot of the people who've bought off the plan or bought in poor locations and haven't had the capital growth. And let's just make it clear, negative gearing is when your income doesn't equal your outgoing, so you've got a cash flow shortage every month. But that's really not an investment strategy. So some people say, I want to buy negatively geared property. Wrong. What you should be doing is buying a high growth property, and depending upon how much money you borrow, in the early years you may not have enough cash flow, so you're going to have a bit of a surplus in your personal income, or maybe a buffer to see you through. But the concept is that should be a short-term thing. Don't invest for negative gearing, because that's not an investment strategy. It's a way you finance properties, James.
Yep.
And just finally, new developments, do they necessarily always equal good capital growth?
Well, people see a new block of apartments going up, or this new housing estate going up, and they say, look, it's actually going to create some jobs in the short term because the builders are going to be there. It's going to boost the local economy because people are going to buy furniture and fridges and TVs and things like that. That's short term, but in general, those things give more supply than there is demand, and so new apartments don't necessarily lead to capital growth. In fact, in the apartment area, there's actually usually a dampening of capital growth because there's too much supply, and much the same in the new estates. Actually, interestingly, only yesterday, I spoke to a client who's bought an off-the-plan apartment in a very prominent location in Western Sydney, and it's come in valued at $400,000 less than his contract price, and he was quite distraught. And the answer is too much supply, and as we've spoken about before, the banks are being very, very cautious about that. So just because there's and this is a nice apartment he's bought, but just because there's lots of them doesn't mean values go up.
No. Great to get those tips from you on how to get that capital growth, even if it's a softening market. Michael, really appreciate your time as always. Thank you.
Thanks, Michael.
My pleasure.
Michael Yardney there from Metropole Property Strategists. We've got to take a very quick break. We'll be back with plenty more after this.
The new 7-seat